unknown entries. It's an unknown entry because this transaction is initiated from the bank. It is difficult for you to keep track of every debit done by the bank because you are a business, you are not an individual. Even as an individual, as soon as the bank charges you, as soon as the bank debits your account, you can't keep track of all the debits the bank does in your account, especially if it is commission. It's not a huge amount of money. It could be $1, it could be 50 cents. So do you want to be recording all these cents, all this little dollar that is being debited from your account? No. The business is so busy to do that. But the bank, because the bank is a systematic, the bank has a system that it's initiating the transaction. It is easy for the bank to keep track of all those things. But it is difficult for the business to keep track of all these charges in the bank. And that is why there will be differences between the bank statement and the business's accounts.
Not a big difference.
Not a big difference, but in as much as it doesn't balance, there's a difference. It has to balance. Is it making sense or not? So the point here is unknown entries which comes from the bank. The bank has initiated the transaction, but the business is not aware that such transaction has occurred. So the business doesn't have it in its own record, but it is in the bank, it is in the business bank account and its bank statement. Do you understand the second reason why it's no balance? And also note that sometimes the business would have records that the bank doesn't have. Like dishonored check. So a business might have issued a check to the supplier. You want to pay your supplier, right? You bought from your supplier, you have to pay. Yes or no? You have issued a check to your supplier, but the check was dishonored by your bank. So your supplier would not, even if your supplier asks the bank why the check was dishonored, check means the check is not being cashed. You presented the check, but the bank does not pay you. That is a dishonored check. So the bank will not tell you why, because the bank does not owe you any reason or any responsibility to explain to you why, because it is not your account. It is the account of their own customer, and there's confidentiality. So they only write in your check, DAR, drawer's attention required. Hello, are you here? The check, as soon as it's been dishonored, the bank will write DAR, drawer's attention required. Take it back to the owner of the check. That's the drawer. So the payer will not pay you. They will not pay you because the check is dishonored. But in your own office account, you would have recorded that you have paid such account. Yes or no? But remember, the supplier might not even bring it. Yes. The supplier might not even bring it. Get the point here? You gave me a check, and the check has been dishonored, but I don't have time to take it to you. So in your mind, you think the transaction is done because it has been recorded in your bank account, in your business account. But the bank has not debited you for such amount. So the bank, you still have more money in your account. So it will not balance with your book balance because the check was not honored. No, it went, but the bank dishonored the check. The bank rejected the check, referring it back to you. Drawer's attention required. The bank will not tell you why the check was not paid because you are not the owner of the account. They only write this on the check. Does it make sense here, please?
Yes.
So I'm telling you different situations that will bring about differences between the bank statement and the office or the business's account. Is it clear? The third reason, either the bank or the organization made an error in the process of recording. The bank can make mistake. Oh, the teller could make mistake. But most of the time, you better focus here. Most of the time, whatever mistake that comes from the bank will find it, will figure it out. Because at the end of each day that passes by in the bank, they have to balance the book. They have to balance. So errors might as well come from the business, not the bank. And the error could be casting. We call it what? Casting. When you are calculating a lot of numbers, there's oversight. You have a lot of figures to calculate, and because of casting them, there's an oversight. You missed out on a number. So because you are missing out on that number, it will reflect. It will reflect in your account. It will not reflect in the bank's account. So anybody could make mistake. The bank can make mistakes, but most of the time when the bank makes mistakes, the bank has the opportunity to reconcile before you as a business, because the bank has a system and the bank has a standard procedure. So each day they have to balance before a new day. But you might say, oh, I'm tired, I will leave it, I will continue tomorrow. But the bank would not continue tomorrow. The bank ends each day transaction. Do we get it? So these are the reasons why we might have differences in the bank reconciliations, the bank statement. Any question about that? Now, the effect of bookkeeping entries on the bank balance. Now, the bank balance can either increase or decrease. What am I saying? The bank balance can either what? Increase or decrease. What are the situations that will bring about an increase in the bank balance? Number one, any lodgements are made to the bank. Lodgement means you are putting money into the bank. You lodge your money into the bank. As soon as you lodge your money into the bank, you have a credit alert. The bank will credit you. So your bank balance does what? Increase, because you put money into your bank account. You put your cash in your bank account. There will be what? Increase in your bank account balance. Any lodgements are made to organizations' bank accounts by others. If I pay money to your bank account balance increases, yes or no? If your customers pay money to your bank account balance increases. So these are two reasons why you could have increase in your bank balance. And probably you have interest received. Sometimes you have there's a fixed asset or fixed deposit account. Here, you paid money for a long period of time, probably 6 months, mostly 1 year and above. Then the bank will pay you interest on it. So if you receive interest from the bank, it also increases your bank account balance. So these are the reasons why you could have increase in your bank balance. Lodgement. Cash is being paid into your account, check is being paid into your account. You receive an electronic payment from a friend to credit transfer. This will increase your bank balance. So what will bring about decrease in your bank balance? Any payment are made by the organization. You make payment to your suppliers, it reduces your bank balance. Yes or no?
Yes.
Any cash withdrawal made by the organization. When you pay to your suppliers, it reduces your bank balance, yes?
Yes.
When you withdraw money from your bank, it reduces your bank balance. Yes or no?
Yes.
And the third one, any financial charges made by the bank, like commission. I told you there's always going to be bank charges. So bank charges will reduce your bank balance. So these are reasons why your bank balance will decrease, and these are the reasons why your bank balance will increase. Any question? Are we sure? So we go back to bad debts now.